Tony Stark is the second richest superhero at a net worth of over $12 billion, but what does he do with his money? We see just a snapshot of the Avengers' lives in these movies. What else do they do with their time? That's exactly what we're looking at in today's video. What would Iron Man invest in, and how can you use it to make your money work for you? We're talking Avengers Endgame and investing today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be with us. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, CNN Money estimated Tony Stark's wealth at $12.4 billion, the second richest superhero, ahead of Bruce Wayne, but way behind Black Panther's $90 trillion fortune. According to Forbes, Stark Industries books over $20 billion in revenue every year. That would make it the 149th largest among U.S. companies. Now, Stark donates to a lot of different charitable foundations, but he still has a lot of walking around money. How would he invest it, and is there something we can learn about Iron Man's favorite stocks? We'll first look at the Tony Stark investing strategy, and then 3 stocks perfect for the Iron Man himself. Now, Stark may act like he knows everything, but when it comes to something outside his wheelhouse, he's ready to defer judgment to the experts. That makes me think that when it comes to making his money grow, he'd be following the strategy made famous by legendary investor Peter Lynch. Now, Lynch ran the Magellan Fund from 1977 to 1990, beating the stock market in all but 2 years and booking a 29% annualized return over that period. In his book, One Up on Wall Street, he's famously quoted as saying, "Invest in what you know." Now, most people read this as invest in the things you buy and use on a daily basis. People end up putting their money in shares of Disney or Ford Motor because they like the products. The problem is, this is the furthest from what Lynch had in mind. Invest in what you know means investing in the industry in which you have deep professional experience. Now, this means understanding how the industry works, how it makes money, and the competitive forces that drive it. You might love the movies and products put out by Disney, but do you really understand how that entertainment industry works? Do you understand how it makes money on licensing, how upstarts like Netflix and now Apple TV are competing for market share, and how Disney's media networks like ESPN are being challenged with that shift to over-the-top viewing? Now, this isn't a new strategy for investing. This is how the analyst world actually works, with most Wall Street analysts working just in a specific sector or a few industries. For individual investors, it means developing that deep expertise in a group of stocks. You put some of your money, maybe between 20 to 30%, in the best stocks in that group. Then you invest the rest in broad index funds that give you exposure to the rest of the market. Now, with this strategy, you're not trying to be an expert in all things. You put most of your money in that diversified mix of funds to get market returns. With that small portion you invest in individual stocks in your area of expertise, you get the opportunity to juice your portfolio with stronger returns. You get a higher upside, but it won't wreck your portfolio if you're off a little because you've still got all those diversified funds as well. So we know Tony is all about tech. He's shifted Stark Industries from a weapons manufacturer to a leading tech conglomerate. He knows the tech side, what's innovative, and he knows the business side. I think I found 3 stocks the Iron Man would put in his portfolio. Our first Iron Man pick is Checkpoint Software, ticker CHKP, a leading pure play in cybersecurity. Now, the company has been shifting to a subscription-based model instead of individual products, and it's really driving stronger sales growth. Customer retention is above 90%, and the company's cloud-based security product is an industry leader. Now, these cybersecurity stocks aren't cheap, but there's a lot of consolidation in the field, and the best of breed are coming to the top. The CSIS puts cyber attacks at a cost to the global economy of over $600 billion a year, and the problem increasingly is coming from large organized networks and state-sponsored actors. Cybersecurity is going to be one of those guaranteed growth sectors for decades. Checkpoint earnings are expected 5.4% higher over the next year to $6.04 a share and a 21.2 times price multiple. Next is Western Digital, ticker WDC, the $15 billion leader in hard drive storage and a growing force in flash storage market. Now, there's been massive consolidation in data storage around that slow death of hard drive technology, with just Western Digital and Seagate remaining to control 80% of the market. Now, WDC has been shifting to flash with its 2016 acquisition of SanDisk and has the scale and the innovation to be successful. It hasn't been an easy transition though, with the shares down almost 50% since March of last year, but the company has paid down over $6 billion of the debt since that SanDisk acquisition and has $4.3 billion in cash equivalents on the balance sheet. That's nearly a third the stock's market cap in cash, so a healthy financial position from which to work from. Earnings are expected to bottom out over the next 2 quarters before rebounding to $5.03 a share in 2020. That puts the shares at just 10 times next year's earnings, and the firmer footing could bring a lot of investors back to the company. While it's not exactly the tech darling it used to be, Apple is still an innovative powerhouse in its sector. Shares are down since last September as new product lines have mostly failed to impress, but this is a company that's evolving into everything we do. Apple went all out to sign the big names like Oprah Winfrey and Steven Spielberg for its new Apple TV launch. The Apple Card has gotten mixed reviews so far, but it's going to give the company a financial component that could pay off strategically. Profits are expected to come in at 3.7% lower over the next year to $11.71 a share, but Apple's near perfect history of beating estimates is likely going to put it back into growth. Even on those low expectations though, the shares still only trade for 16.5 times earnings, so not a bad entry point on valuation. We're doing a whole series on Avengers Endgame investing, from Captain Marvel to Iron Man, Spider-Man, and the Black Panther. I'll leave a link in the video description below, but be sure to click that little red subscribe button so you don't miss a video. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just subscribe to the channel, scroll down, and ask it in the comments. We'll make sure you get an answer in a future video.